Well, housing starts drop in October as builders continue to pull back amid high prices and mortgage rates. The Trump administration has recently made proposals aimed at tackling the affordability crisis, but is it enough? Here to discuss, we got Redfin chief economist Daryl Fairweather. Daryl, it is great to see you. Maybe actually, Daryl, let's get your response to the data we got today. I'm curious what you made of it. Housing starts, which is another name for new home construction, slumped 4.6% in October. Starts reached 1.25 million in October. That was the lowest level since May 2020 per KPMG. What did you make of that report, Daryl?
It was a disappointing report, but not unexpected. The big boom in housing construction that started when mortgage rates hit record lows during the pandemic is pretty much over now. And moving forward, we expect this to put pressure on rents, especially because multifamily construction is pretty depressed and more people want to rent. So it may not show up in home prices, but it will show up in rents, we think, next year.
Let's Daryl talk about President Trump, because housing, he knows, is top of mind. He's making headlines there. His new idea, calling for Fannie and Freddie to buy $200 billion of mortgage bonds. What do you make of that idea, Daryl, and its impact on mortgage rates? With we should note the 30-year fixed here below 6%.
Well, on the announcement alone, we saw mortgage rates dip today, and I think that's a good indication that that policy would actually result in some tangible improvements in affordability for borrowers. But it's not a long-term solution. We really need more housing in order to bring housing costs down. It's just the fundamental supply and demand problem. We have not been building enough homes for everybody who wants one, and we're at about a 4 million home hole that we have to build ourselves out of.
What about, Daryl, Trump's other big idea? You saw this, of course, made a lot of headlines. Trump says, you know what we should do? We should ban big institutional investors from buying single-family homes. You saw that, Daryl. What'd you make of it?
That proposal, I don't think, would help one way or the other. And we've seen this proposal from Democrats and Republicans. 2 years ago, I wrote about how California was proposing to ban institutional investors. The issue is that institutional investors make up a really small share of home purchases. And if you banned large investors, they would likely just be replaced by smaller investors, not necessarily first-time home buyers. And you have to remember that these investors are renting out these homes to renters. So maybe it would, in the best of cases, help first-time home buyers, but it would be at the detriment to renters.
So let's say I put you in charge, Daryl. I said, all right, Daryl, what is the game plan here? What is the war plan to try to make more homes more affordable for more Americans? What do you think the answers are there?
Well, it depends what you put me in charge of. If you put me in charge of federal policy, I would be pushing Congress to give HUD the authority to override local zoning laws, especially near big federal investments like transit infrastructure in states. If you put me in charge of states, the path is a lot clearer. You would just eliminate single-family zoning and allow for multifamily zoning, cut all of the red tape, and allow us to build denser homes in the places that people most want to live.
What do you think the odds are, Daryl? Because you're not the first economist who really thinks deeply about this issue that's brought up some of the dynamics at play on state and local level. I mean, any line of sight into whether you think you could see movement there, the kind of movement you're referring to?
Well, we have seen a lot of progress. In California, they have reformed their zoning laws. They can now build dense housing near transit. You can build up to 2 ADUs on any single family lot. California has other problems, though, especially with their tax code. Prop 13 means that homeowners can keep their property tax bills essentially fixed. There's no incentive for any owner of a single family home to develop it or to sell to somebody who will. So it's going to definitely be a slow progress that we're seeing across the country. Some places will move quicker because they have more of a culture of building like we see in the South. But places like California, it could be a very long time, but I think that shouldn't deter us. We should put the investment into these projects, even if it might take years to see the fruit of them.
Finally, Daryl, I only have about 60 seconds left here, but we've been talking nationally, big picture. What about regionally, Daryl? I'm just curious. Are there important trends and themes that you're seeing playing out here that we need to be aware of?
Well, Florida is definitely a state to watch. It was a really weak housing market last year. The cost of living in Florida went up. There was a glut of inventory of condos, so prices of condos went down, especially on the coast where insurance costs are going up. So I think that's a market to watch in terms of whether that weakness continues. Markets that we expect to be hotter, those are more in the Great Lakes region. We think a lot of New Yorkers will move upstate or move to more Midwest metros where homes are still quite affordable. You can buy a single family home for $300,000 or even $200,000 in the Midwest. So it's one of the last affordable places to go.
Daryl, always great to have you on the show. Enjoy the weekend.
Thank you.
Early measures that we're seeing this administration try to put in place on the affordability front. I mean, as an investor at this point, do you have to try to then maybe theorize to some extent about what may be coming down the pike on that front and get ahead of it?
No, I think so. I mean, I do agree, or I do believe that, as we just talked about earlier, this is more of the appetizer when it comes to GSEs buying, because again, you'll have the mortgage rate might decline on that somewhat, but depending on what the 10-year Treasury yield does, but it's not going to get to the level where it's going to, influence affordability materially. I mean, in order to really do that, unfortunately, you have to be more on the supply side, in my opinion. There's demand side things that can be done, maybe in Davos they announced some sort of reignite of the Operation Twist or something that bring down that 10-year Treasury yield. But otherwise, a Fed cutting once or twice is just simply not going to do it. And, I do agree, when we talk about this productivity, the number of 4.9%, obviously it can be very volatile. But even when you look at the, 10-year average, it's running about 2%. But this sort of no higher kind of environment, I do think is going to be an issue down the road. And when the Fed cuts once or twice, you're not really doing anything to help that part of the equation. It might be great for small businesses, it might help a little bit in terms of someone's car loan, but it's not going to be enough of a push where you really influence the K-shaped economy. Or do we think it's going to really, this recent measure, going to heavily influence the affordability issue? So I do believe there's going to be much more down the line. But again, there's things that they have to be considered. Like if you give tax incentives, you got to go through Congress. You have to look at the deficit. I mean, there's a lot of obstacles to go through before we can really address this issue.
Trump saying in a social media post he has taken steps to ban large institutional investors from buying more single-family homes and will be calling on Congress to codify it. Joining me now on what this could mean for the housing market, we've got Lance Lambert, CEO and co-founder at Resi Club. Lance, it is great to see you. So let's start right there, Lance. President Trump says, you know what we should do? We should ban big institutional investors from buying single-family homes. What do you think, Lance? You saw the post. Smart policy?
Well, I think the big thing is we don't exactly know what's going to happen here. So we don't know if they're just going to ban new investment from scatter site home buying. We don't know if this is actually going to be implemented. Is Congress going to pass it? Will it be challenged in court? Is it going to include build to rent? Is it just scatter site? We still have a lot of questions. But what we do know is that whatever happens, if they are to pass some type of institutional home buying ban, it would impact, the impact would vary a lot by market. And the reason being is that the institutional levels of home buying are vary significantly across the country. So nationally, the institutional investors that have 1,000 homes or more, they own around 0.5% of housing stock. If you take that threshold down to investors with at least 100 homes, then it's about 1%. But if you go across the country, there are many markets where it's closer to zero, but then you have places like Atlanta, where 4% of all single-family homes there are owned by institutional investors that own at least 1,000 homes. And within just single-family rentals in Atlanta, that figure jumps up to around 25%. So the impact will vary significantly across the country, whatever were to happen. If you did have a scenario where this is not just a ban on buying new acquisitions, but it's also a forced sell-off, then the impact would be greater because you would start to see some burst of new listings in some of these markets, in Atlanta, in a Charlotte, in an Austin, in a Tampa, in places like Jacksonville that have this higher concentration of institutional home ownership. As of right now, though, It's unclear if that's going to happen. If you read Trump's post really closely, he had said stopping them from buying more. More kind of insinuates additional purchases, not necessarily a forced sell-off. So there's still a lot of questions, but whatever does happen, it's going to vary a lot by market.
Lance, let me ask you, one question is placing your bet on whether you think, Lance, this actually goes from social media post to actual policy, Lance. I guess I'm trying to get at how seriously should we take this, in your opinion?
Yeah, when Trump announced his proposal for the 50-year mortgage, I polled 1,000 people within the next 24 hours, and it had a net favorability rating of 50 percentage points. So the vast majority of people were against the idea. And so as soon as Trump announced the 50-year mortgage, it was dead on arrival, right? Because that's how Trump does things. He likes to test them, see what the public thinks. And when you look at this proposal, I did the same poll, 1,000 people answered it, and it had a plus 50 percentage point net favorability rating. And it was really across political party. It's a very populist idea. A lot of people like it. So I don't know if it'll actually become law, but I don't think Trump's going to step away from this concept and the idea because it's going to get headlines and a lot of people like it.
Let me ask you this, Lance, and your timing is impeccable as always, my friend. We have a new post from the president. Right in your wheelhouse. I'll read it to you. Get your thoughts on this. He says, because I chose not to sell Fannie Mae and Freddie Mac in my first term, a truly great decision, and against the advice of the experts, it is now worth many times that amount, an absolute fortune, and has $200 billion in cash. Because of this, I'm instructing my representatives to buy $200 billion in mortgage bonds. He says this will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. It is one of my many steps in restoring affordability, something the Biden administration absolutely destroyed. I'm reading this, your reaction in real time, Lance. What do you make of that post?
Yeah, so the big thing to know is that in the bond market, yields and prices work inversely. So when there's more demand for the bonds, more demand for mortgage-backed securities, the yields and rates go down. So when the Federal Reserve during the pandemic boom period is buying a bunch of mortgage-backed securities, that's increasing the demand for those securities and driving down the yields, driving down mortgage rates additionally. And what we have seen is that last year, at the end of last year, Fannie Mae, Freddie Mac, the government-sponsored enterprises, started keeping more and buying some more mortgage-backed securities. Now, in the grand scheme of the mortgage-backed securities market, it was around $100 billion. That's not too big. But if you go to this year, according to Bloomberg, they expect that the Fannie Mae, Freddie Mac is going to buy around $200 billion in mortgage-backed securities. So it's a bit of additional demand for the mortgage-backed securities. It's probably putting maybe a teeny tiny bit of additional downward pressure on mortgage rates. You have seen mortgage rates come down over the past 12 months, around 75 basis points. The average now is around 6.1, 6.2. It was around 6.8, 6.9 12 months ago. That's come down a bit. And a lot of that drive down in mortgage rates is not necessarily been because of the drop in other yields and treasuries. It's been because the spread between mortgage rates and the 10-year treasury yield has compressed. It's been compressing. That spread got really big when the Fed stopped buying mortgage rates back, or buying mortgage-backed securities back in spring 2022. And slowly that spread has been coming down. There's been compression there, and that's helped to bring mortgage rates down a bit. So it's possible that some of these measures by Trump could put a little bit of additional downward pressure on mortgage rates. But still, the big thing to watch here is the overall economy. If we were to see unemployment rate tick up more than expected, if we were to see a greater softening there, that's the scenario that would see us have a more material drop in mortgage rates than is currently expected.
Lance, we always benefit from your great insight. Thanks as always for joining us.
Thank you for having me.
Mizuho is downgrading American homes for rent and Invitation Homes to neutral from outperform after President Trump announced he plans to ban institutional investors from buying single-family homes. Joining me now, Handel St. Just, Mizuho America's Senior, a real estate investment trust and home builder analyst. Handel, thank you so much for being here, because This is a bit of a confusing situation, I think, for some investors, right? President Trump, comes out with these pronouncements. Then we have to figure out how is it actually being implemented? Will it actually be implemented, and what effect it will have? So I know part of that is your job to figure all of this out. So how are you thinking about those issues and whether this is going to have an impact?
Absolutely, and thanks for having me. So yes, needless to say, the tweet on Wednesday was a bit of a surprise out of left field. Certainly wasn't something that we, the analyst community, investors, even the companies were expecting. And when we step back, certainly feel it's a bit of an existential threat to the business model and growth prospects. So lots of uncertainty near term as to what you alluded to, the timeline, what ultimately gets implemented. Right now, I think there's a bill that's recently proposed in Congress by a Republican senator from Ohio to codify the proposal. But what comes next, the timeline, look, Trump's going to be at Davos in a couple of weeks as a State of the Union. We expect to hear more on this. But in the near term, we felt going to the sidelines on these stocks made sense.
So the business model of these companies, just to be clear, for people who are watching at home, at what kind of cadence do they buy homes? So they buy them and then they rent them out. But in what volume are they typically buying? Because this order, if it does go into effect, seems to imply they can keep the homes they own. It's just a matter of the ability to buy new homes.
Absolutely. And that's an important point. The second point you made, I think Treasury Secretary Bessent walked back some of the threat yesterday by saying that there won't be any forced liquidations. But going to the initial part of your question, look, these were companies born out of the great financial crisis. There was a significant amount of buying back during the middle and latter part of the prior decade. That's slowed in recent years. These companies aren't buying as much as they had been 7-10 years ago. Now, part of that is because the opportunity has waned. There's not as much homes for sale in the MLS inventory. Home prices have recovered quite a bit too. So some of the returns have been interesting. In more recent years, there's been buying more directly from home builders. But if you think about this business model over time, a good chunk of their growth is going to come from internal operations. They can generate 3 to 5% of what we call same-store net operating income per year when you factor in revenues and expenses. But the external growth is, to a degree, largely tied to acquisitions. Now, certain companies, American Homes for Rent, is an active developer, so that's another question. Will they be able to, and it seems so far that that's the case, be able to continue to develop and add homes to their portfolio? But the other company, Invitation Homes, is not an active developer yet. And so I think for them, it's a bit more of a direct impact to their capital deployment. These companies have also gotten into third-party management in the case of Invitation Homes, lending, but acquisitions had been a key piece of the business model for years, have slowed. But as we think about the forward prospects, certainly something that's now off the table.
And Handel, as you point out in your note on all of this, professional investors, institutional investors, put another way, own about 3% of the overall single-family housing stock. So in your assessment, has their ownership increased the pressures on affordability in the housing market, either on the owner side or on the renter side?
So I think overall, as you pointed out, it is a small number of the overall national market. But if you think about where the footprints of these companies are, largely in the Sun Belt and concentrated in cities like Atlanta, where professional or institutional landlords are closer to 10% plus of the stocks of single family homes in those markets. So the overall stats, on a national level don't look to be as meaningful, but, it does look a little bit different when you focus in on the markets where they're most concentrated, the Sun Belt, which is where the opportunity was greatest following the great financial recession. And so I think at the margin, it's not a big number, but when Americans, young couples, go to buy homes in a number of these markets, there hasn't been much availability in prior years. And when they go to the process, oftentimes they're beaten to the finish line by institutions who can buy cash, who can do underwriting more quickly. And so the opportunities you think about over the longer term for young couples, young adults to generate a nest egg via the value appreciation of a home in some cases has been, taken away. Now, that's not to say that the opportunity still isn't there, but it just makes it a bit more challenging at the margin when there are corporations actively bidding in markets where there hasn't been as much inventory.
That's really helpful context, particularly that focus on the sort of regional versus the aggregate nationally. Something else I wanted to ask you about, Handel, with regard to this market is the other measure that the president has talked about, and that's Fannie and Freddie buying some mortgages, some $200 billion in mortgage-backed securities out of the market, which he hopes will bring down mortgage rates. And Fannie and Freddie do some of these operations already. And so I'm curious how you're thinking about that potential effect.
Well, to be fair, that's a little bit beyond my purview. I understand the impact certainly is, in the desire of the administration is to make homes more affordable. To one degree, bringing rates down, but also increasing the availability of homes, which is part of, I think, at the heart of this ban on institutions. So I think for the administration going into midterm elections, obviously affordability, inflation, all these items are front and center, and certainly I think a very important political point for a number of folks running for office. And so I expect that these issues will remain front and center. We'll hear more initiatives, but ultimately I think something needs to be done here. Obviously, there's a lot of folks who are just simply purely unable to buy homes. And we think about what the single family rentals, just to tie them back into, offer. Look, one of their talking points is they can offer quality homes for Americans at a price far below the cost of ownership, on average $900 a month in their market. So that's meaningful. So something clearly needs to be done on the affordability and the availability side.
Handel, really interesting perspective. Thank you so much. Appreciate it.
Thank you.
I was just checking out the mortgage rate data coming out today from the Mortgage Bankers Association at 6.25%, the average 30-year fixed, down from 6.32% the prior week. But I know you've got your eye on some of the sort of bigger picture trends that aren't necessarily supportive of the housing market this year, right?
Yeah, so rates are part of the equation, but home prices are an equally, if not larger, part of the equation. So that really is the sticky point in affordability. So you can lower rates, but if prices don't come down, affordability still is very problematic. And there's another issue too, which is there's very low inventory and there's very low sales volume because they're a very low inventory. So 60% of existing homes are owned by seniors, people over 60, and they're not selling. So they're living in their homes for longer. They are aging in place, which means there's less property on the market and less inventory, churn, which keeps prices high. And the other thing that happens is that when seniors and homeowners are facing the same affordability issues that so many Americans are, they are increasingly tapping into the equity in their homes. So there's 36 trillion of equity in homes, and I estimate there's about 26 trillion in tappable equity. Only just over 400 billion is tapped today, and that's again very low relative to historic basis. So if you looked at 9 trillion of equity back in the where the housing crisis occurred, there was over 700 billion of home equity available. So the dynamics are not going to improve anytime soon. So last year, 2025, there was just over 4 million in existing home sales, and the estimates this year are a little bit higher, but not much. So I think the existing home market stays gummed up, and the fastest growing loan category is home equity. We think that there's a home equity renaissance going on, so that more and more people are going to tap into the equity to make ends meet. So increasingly, more people are using home equity as a cash management vehicle, whereas historically they've used home equity for home renovations. That's down. Cash management is up. So you get into home affordability, which I think is going to be a central issue of midterm elections, and that's really going to focus then on new home building, and a lot of it then is going to focus on manufactured homes, home building, because that is so much cheaper than the site-built homes.
Okay, so there's a lot to unpack there, Meredith. So let's slow down for a second and do that. We've talked before about the home equity boom the loan boom that you're predicting, and some of the potential beneficiaries of that, from companies like a SoFi to a Rocket. How do you think that's going to play out this year? And do you think that traditional finance will also get a piece and benefit, or is it just that it's so much a smaller part of their business that it's not as meaningful for them?
Well, Julie, you nailed it. So Bank of America is the biggest home equity lender, but it's a tiny part of their business and not one they really focus on. One they extend to their high net worth clients, but one they're not interested in building that line of business dramatically. So it's really the non-bank players that have been the bigger growers. And so you had Rocket and SoFi be big in that space, and Rocket more of a home equity play than SoFi. SoFi we're recommending because it's an originate and sell model. So they've got so much interest from private credit wanting to buy their loans that they can originate and then immediately sell, which turns them into a much higher volume, higher margin play. But both stocks benefited last year. Now, both stocks were up 85 and 75% respectively, Rocket and SoFi, and they benefited from the fact that there's a very robust pipeline of home equity companies that are set to go public. So Figure went public in September of 2025, and both Rocket and SoFi benefited from margin expansion because of that deal. So they're about what we estimate to be a half a dozen home equity stocks set to go public. These are private equity funded companies, and private credit buys their loans. So private equity needs an exit strategy. They're on deck to go public. So there's a lot of momentum behind this sector, and there's a lot of demand from consumers who want these loans. So that's why we think it's a home equity renaissance and what we call a fat pitch investing opportunity here.
And by the way, Figure itself has also done pretty well since its IPO. The stock is still, I think, more than double the IPO price. I want to get into manufactured a little bit because this is a fascinating area to me. And when we talk about manufactured, people are watching, we're talking about what we used to call prefab housing, right? You build it somewhere else and then you take it to the place, or it's easily assembled. I mean, like, people like Martha Stewart are now designing these kinds of houses. And in the past, I think you could argue there was something of a stigma around them. Does that go away in 2026? Do we see a manufactured housing boom?
Julie, I'm so glad you're as into manufactured housing as I am, because I could talk about it all day long. People look back on the pre-1970s as like a trailer park type manufactured housing. Manufactured housing today they're really nice. So not only are they oftentimes 25% of the price, but they're incredibly I would say high end, very, very nice. So what's interesting about this, and why we think this is also a fat pitch opportunity, is there are as little as 100,000 manufactured shipments annually. It bobs around right 100,000. So when you move manufactured housing, there's a requirement from the 1970s, which is a chassis requirement, where you have to move the manufactured home on a steel platform, and then you have to install it with the steel platform. So both the House and Senate bills repeal this really outdated structure, this chassis mandate, and that would lower the price of manufacturing by an estimated additional 25 to 50%. And importantly, the Manufactured Housing Association on Regulatory Reform thinks that it will increase shipments from 100,000 to 500,000. So that's obviously a quantum increase, and what it would do to companies like Champion Home, Sky, would be massive. And there's Cavco that benefits as well. So these are quantum shifts in a business environment and volumes that could happen with the stroke of a pen from reconciliation from the House and Senate. And the House and Senate, by the way, are motivated to pass this in the first quarter this year. And then of course the White House wants to be heavily involved in affordable homes too. So at the center of this affordable home, I think, is the manufactured housing stocks.
And so basically this is an election issue in your view because of the whole discussion around affordability.
Without a doubt. This will be the domestic election issue for the midterms.
Meredith, thanks so much. You got to go peruse those Martha Stewart prefab homes. They're definitely not what you imagine when you think about it. Thanks so much for coming on, and we'll take a look at Champion Homes as well. Appreciate it.
As you turn to 2026, what are you expecting to see, Noble? Compare and contrast it to 2025. It was about high borrowing costs, high prices. What do you forecast?
I think it's going to be more of the same, but a slightly better version. I think it's going to be somewhat of a reset. Rates will come down, I think, a little bit more, but not nearly as much as we want them to, or as much as we thought they were, let's say 6 or 12 months ago. But I think it's moving in the right direction. I think another big positive piece of information is you've got a lot of eyes from both sides of the aisle focused on affordability. There's a lot of different solutions. Some people are just saying we're going to fix it without solutions yet, but at least that's something that's getting attention. And I think really around the country, that's something that needs to be solved. So at least there's energy there, I think, in a way that's not been there in the past.
To your point, a lot of talk on both sides of the aisle. We know we're talking nationally, but if you turn your attention regionally, Noble, as you look at 2026, would you guess, okay, there's going to be certain regions that will be relatively stronger, relatively weaker? What do you think?
Yeah, I think in general, everything's going to do slightly better than what it's been doing for 25, right? You're definitely seeing the Northeast definitely doesn't have enough supply. I think prices there are continuing to rise. You're seeing softness in some of the Sun Belt, some of the South, some of the Southwest, like Southern California. That's where places, basically Texas, Arizona, Florida, places like that, where they did a lot of building coming out of COVID, where there were less regulations, less restrictions. They're catching up with that inventory, so prices are softer. But then around the country, it really is market by market in terms of what the job markets are like, what the prospects are economically there, and then where housing prices are.
What do you see in your market, your expertise here in New York?
I do New York, yeah. So I do New York City and the Hamptons. We're very strong. We had an incredible year this year. I think going into next year, we're expecting that to be better. I'll tell you that, really for the last probably 15, 16 months, we've been on a tear, and I think that will continue. It's very specific, even within New York City, though. It's almost block by block. So, if you're looking downtown, something that's turnkey, the prices are astronomical. There was something that was signed 2 weeks ago downtown, the largest number downtown, for $129 million. Huge, right? But then it's a buyer's market if you're looking at something that needs work on the Upper East Side. So it really is very specific of what you're looking at. The Hamptons are very strong for prime product. For the kind of entry level, it's a slightly different story. But I think with my market and then also nationally, you've really got to get in and kind of see it's the specifics, and it's the local is what really matters. It's not one giant kind of take on the whole.
Now, because your expertise is New York, I got to ask you, Mayor Mamdani, are you seeing any signs, Noble, of an exodus by the wealthy, making tracks to Palm Beach? Are you picking up on that? Are you seeing that? Are you hearing that anywhere?
I'm hearing it all the time. Like everyone's talking about it. Everyone's asking exactly that question, and it's a topic of conversation with everyone. The only thing that the numbers have borne out, the only thing that I've seen is after he won the primary, I had 2 clients that backed away. They both came back into the market before the general. The numbers don't bear out that people are listing their homes. We haven't seen buyers backing away. Now, look, I don't think that we've had a mad rush of people buying because he won, certainly, but the market's been incredibly strong. The week that he won the general election, it was one of the strongest Novembers that we've had in 10 years. I think it was the second strongest in 10 years. And half of those contracts, if not more, were signed after he won the election. So, the ideas that he's putting forward, a lot of the proposals that he has certainly are giving concern to a lot of people. But I think, at least for a lot of our clients, there's a thought that, number one, he's going to moderate some of that. And number two, he's probably not going to be able to get what he's talking about done actually done, right?
Yeah.
Or at least a lot of that. And, it's not the case. I think everyone, particularly South Florida brokers, are like, come down, everyone's leaving New York. The people that were especially sensitive to taxes left years ago. I mean, that's something that we've definitely seen in the city. That's something that the politicians have to get in control, and I don't think they're doing yet. But the people that were especially sensitive to that have already gone. The people that are scared of Mamdani, they're not the people that all of a sudden, because he won the election, the next day quit their jobs, pack up their family, and move. I think if he does what people fear, that's something that takes time, and I think people have not given up on the city yet, and with good reason.
Let me ask you, you mentioned earlier how politicians on both sides of the aisle, this is an issue now. And you heard President Trump saying he's going to prioritize housing affordability. I think details are kind of scant there still. What could he do? What should he do? I mean, ultimately, you want to boost supply, you want to bring the prices down. What would you look for there?
Yeah, I mean, look, I think that boosting supply is definitely the biggest thing. I think that's what's going to get us out of this. It's not, it's not about curbing rents or anything like that. Most of that, unfortunately, is at the local level, right? So it's a matter of like, what are these localities, the states doing? I think the thing that the federal government can really do is set examples. So have commissions that come together and say, look, these are the bare minimum standards that we need to have. All of these other rules and regulations, let's condense this. Let's cut red tape. There's definitely a role for the federal government to go in and cut out the unnecessary bureaucracy that's standing in the way of things. And we can go through countless examples of, energy standards or, disaster standards, all of these things that are well-intentioned, but they add cost onto the cost of a new home, which make it that much harder that somebody can afford that, right? And ultimately, we want people to afford housing, not to live in the most safe or the most environmentally friendly house they can get, but it takes them 30 years to be able to afford it. I think setting the example with that is the biggest thing, and really going through and looking at each of the different departments, the different bureaucracies, and what can be combined, and what are the best practices, and what are things that are standing in the way of what our goal is.
Joining us now on how investors can capitalize is Hassam Naji, Marcus and Millichap CEO, which is one of the largest commercial real estate brokerages in the country. Good to see you, Hassam. So, indeed, it's been a little bit of a rocky road here, and commercial real estate is a big category, right? We're talking about offices, we're talking about retail, we're talking about some other categories. What changes going into next year do you think that will sort of cause a more positive inflection?
Good morning. Thanks for having me on the program. It's great to be with you. The most important element going into 2026 is the effect of time. We've now had almost 3 years of a market disruption, and the first phase of these interruptions in capital flows and questions about valuation when interest rates are spiking as they were over the last several years is pricing, and how do you value real estate. And that first phase of a disruption is always kind of a deer in the headlights among sellers and buyers. So the market really experienced that shock in 2023. We saw a little bit of a recovery in 2024 and build on it to some extent in 25, although 25 was somewhat disappointing because of the Fed change in strategy going into the year was to be much more accommodative than the Fed turned out to be in 2025 because of tariffs and some other noise in the marketplace. Going into 2026, we've now had the time element of price adjustments. That's probably the most important element in commercial real estate as investors value alternative investments and yields. So with prices coming down pretty measurably in the last 2.5, 3 years in pretty much every property type, we now see a very big advantage to replacement cost. The cost of building new structures has been soaring, land costs, labor costs, and so on, and it's getting harder and harder to build new commercial real estate product of any type. So that measurement alone is bringing a lot of capital back into the market, number one. Number two, despite what the Fed is saying, we believe that the economic slowdown, especially with the job revisions that we saw a few months ago, will sort of force the Fed's hand to become more accommodative. So interest rates are most likely to go down than they are to go back up. And that's going to be a major catalyst for transactions as well. Commercial real estate is very dependent on the cost of capital and uses leverage quite a bit as an asset class.
So Hassam, as I mentioned in the beginning, it's not a monolith, right? There's lots of different subcategories. So talk me through some of those categories. I imagine it's office that fell the most and has the most to gain, but tell me if I'm right about that, and what's the outlook for that part of it in particular?
You are absolutely right. The office sector was hit extremely hard in this last cycle, unexpectedly, of course, because of the pandemic and the after effect of remote work and then hybrid work. But the company mandates to bring people back into the office in the last 18 months has really worked. About a year ago, daily office attendance across the country was around 55 to 60% at best. And now it's sitting at about 80%, maybe even north of 80% compared to 2019, pre-pandemic levels. So it's improving for sure, but unlikely to go back to where it was pre-pandemic. I think the work environment of at least 1 or 2 days out of the office for most workers is here to stay. So demand will be permanently lowered, we believe. But the good news is that there's been very little new construction of office product for quite some time. But you're right, the values in that sector were hit the hardest, as you would expect, as was the loan performance, put a lot of pressure on banks. But as we're coming out of it for 2026, the most favored asset class, believe it or not, is retail. Because retail went through a significant restructuring because of e-commerce, and brick and mortar retail was under so much pressure for the better part of the last 20 years. A lot of shopping centers have been either modified or rebuilt or even converted entirely to other uses. So there has been a supply reduction in retail. And the consumer is back, of course, with experiential retail, foot traffic into restaurants, bars, and fitness and beauty related kinds of reasons to go to a destination retail shopping center has increased dramatically. And it's doing very, very well. Multifamily apartments have always been very stable. Going into 2026, the price corrections in that sector make it very attractive. We're seeing lots of activity. But what's interesting, as you said, in commercial real estate, you have self-storage properties, you have mobile home parks, you have seniors housing facilities. It's a really diverse way to invest in real estate, and the tax package that passed in 2025 saved or added to a lot of helpful provisions for commercial real estate investing, which is another reason we're seeing capital come back into the market.
Has within retail, just to dig into that one a little bit, obviously retail goes through different sort of cycles of what's popular. You know, we went through the mall dominance of the 80s into the 90s. Then we went sort of big box shopping centers. With this rationalization that you talked about that we've seen over the past few years with a lot of closures, what's the emerging trend out of that in terms of the new hot retail format?
Open air centers and power centers with discount shopping in a Costco destination type of value retail or TJ Maxx, those are doing extremely well. But broadly speaking, what's happened with retailers have become so much more intelligent about maximization of the use of space, in that they're having smaller footprints, less cost carry for inventory in the store, and more of a customer experience. These days, with online ordering and all that, the need to store goods on site has diminished tremendously. So the focus is on the customer experience and reasons to attract foot traffic. This is where restaurants, bars, fitness, and beauty come in, as the population basically seeks those kinds of experiences. Being able to shop while you're out there is an important factor. Interestingly enough, as the office market was suffering post-pandemic, daily traffic into retail was increasing because everyone who was working virtually wanted to get out of the house and needed a Starbucks or an internet cafe. And that brought in a lot of daytime traffic, which would have been completely unexpected. This is one of the points about commercial real estate. It's always pivoting and shifting to whatever's happening around us. But I would say that the use of space and efficiency in inventory management is probably the most important aspect of retail. We're seeing a lot of digital brands that were never in the brick and mortar business now open shops and expand into brick and mortar retail to have more of that omni-channel exposure to customers.
And one other, speaking of the adaptability within real estate, we seem to be seeing quite a trend of office to residential conversions, office to apartment conversions. Part of that a factor of the weak office market, I imagine, over the past couple of years. And the numbers are pretty dramatic. I saw one estimate from Rent Cafe that there are almost 80,000 unit conversions in the pipeline, which seems like a lot. Have you seen that in your career before? I know there have been sort of these trends before, but how is this one different, and what should we be paying attention to?
There's definitely more and more examples of older, obsolete office buildings that have a really hard time competing with newer properties being converted to residential. But it's very limited. Actually, the numbers that you just quoted are large in volume, but as a percent of the total universe of residential housing for rent, or even if you look at it on the flip side, the office inventory, it's a very, very small percentage because it's extremely expensive and difficult to do so. When retail was hit really hard, the reimagination of a shopping center or even a complete reuse of a shopping center is a lot easier and cheaper to bring about versus a mid-rise or a high-rise office building in an urban market, which is where most of the pain has been located. I should mention that the bifurcation of office product, Class A, which is essentially newer, more modern properties built in the last 15 or 20 years, has done much better than older, more Class B, Class C office buildings, especially in urban markets. Suburban office has actually performed fairly well in this downturn.
A recent report from Realtor.com made headlines when it found the median age of all homebuyers was 59 and first-time homebuyers averaged 40. My next guest says those ugly headlines might make the housing market look worse than it is, and that there are some bright spots ahead in 2026. Jeff Taylor, Emphasis Digital Risk founder, joins me now. Jeff, that data came originally from the National Association of Realtors, and it was survey data, and it got a lot of attention, and people looked at it and sort of said, I'm never going to be able to avoid a house. Only people who are older can avoid a house. How did you interpret those numbers?
It's really great to see you, and thank you for having me. And so if you take a look at it, that survey, those numbers came from a survey that was 6,100 people, okay? So it's a very small subset. Number two, when you actually peel it back and look at what is the average median age for a home buyer, it's still 32 years old. It's been that way for over a decade. So when you really get to, and you brought it out, it really, really is there. So first-time home buyers, are in relatively good shape. And the reason why I say relatively good shape is right now, if I look at the overall market, first-time home buyers are still only 21% of the market, and that's a lowest number since 1981. So we definitely do need to see first-time home buyers coming back into the market in a more significant way. But we have a lot of optimism. I think they should.
Where does that optimism come from? What is going to change in this market that could make it more accessible to those first-time home buyers?
That's a great question. So as we look into 2026, right, we have a Fed who's going to most likely cut today another 25 basis points. And I think that we could see mortgage rates dip back into the high fives in 2026. So I think that's going to increase people wanting to come into the market, number one. Number two, if we look over national home prices in all states sort of came back around 3% last year for the first time, down. Now, that's nowhere near a market crash, right? A correction is usually 20%, but this 3% starts to show that it's becoming a little bit more affordable, and hopefully we see another 3 to 5% in 2026, so that can help affordability.
At the same time, when I talk to some folks within the fixed income market on which mortgage rates are pegged, they say even if the Fed starts to cut rates, we might not see, sort of those long rates come down that much, and therefore that we might not see mortgage rates come down that much. What do you expect?
That's exactly right. And if you look at the first two rate hike cuts that we had this previous year, actually mortgage rates went up. So when we see the cut today, I don't necessarily think that they're going to go up, but they could. But if I look into 2026, right, we're going to have a new Fed chair. And as we expect it to have the Fed rate actually cut a little bit more, as long as we don't have inflammatory concerns, then you could see mortgage rates come down. But if we're worried about inflation, then mortgage rates may come back up. So again, I don't think we're looking to see low fives in 2026, but the ability to get mortgage rates back into the high fives is something that we are optimistic on, for at least for a period of time in 2026.
And Jeff, I wanted to ask you about another stat, and this one came from Realtor.com, and it's about delistings, right? Somebody has a house on the market, it's not selling, they don't want to cut the price, and so they take it off the market. So we saw a 38% increase in those delistings year over year. What does that tell you about the market right now?
I think that ties back to the national decrease of home prices of about 3% over the course of the last year, is because people for a long time have been able to essentially name their price, and people put their house in the market, people are hitting the full price or a lot of times bidding it up, and that has started to shift. It is becoming more of a buyer's market. It's not a huge buyer's market right now, but you're starting to see that transition, which the first indication of that usually is people delisting because they get frustrated they're not getting their price. they go back, they sit in the sidelines for 30 to 60 days. Then they maybe have a little bit more of a dose of reality and they relist at a lower price versus accepting a lower price on their initial listing. It's a little bit of psychology. You need a little time to cool off and realize what the new landscape looks like, but that's what we're starting to see.
Jeff, we keep having a conversation about affordability. This is what everybody is talking about right now. And obviously housing is a big, big part of that. It's a big part of your monthly. It's the biggest part of your of what you're paying out monthly. What you're talking about is mostly some changes on the margins. Do you see anything from a policy perspective or anything bigger that is going to change the affordability, the housing affordability equation?
Look, we still have an issue, right? If you have the existing home price and new home price around $415,000, that is essentially still too high from an affordability perspective. But if I go back to January, mortgage rates were averaging around 7.25. Today they're 6.25. So on a 30-year mortgage, that on a $400,000 house, that's a savings of $266 a month. Again, that's not a silver bullet. You could still say that's a little bit on the margin, but I think things here are going to take a little bit more time, right? And then we could see mortgage rates come back down to where it could actually help on the affordability aspect, as long with also, again, as supplies that cost to make these houses, right, as the tariffs fall off and what have you, and the cost of materials to build houses come back, especially in that sector. I think that will become a little bit more affordable going forward.